A lot of people looked at Poland buying gold and treated it like a quirky local story. Nice headline, interesting central bank. Move on. I think that is exactly backwards. Because when a country like Poland keeps buying gold aggressively, even with gold already expensive, you should not ask why Poland is weird. You should ask why Poland may be early. That is the real story. I am recording this right now from New York, and I want you to comment what day and date you are watching from, because I always love seeing how far these videos travel, and I want the timeline to be crystal clear because this story moves fast. And real quick, if you value this kind of direct market analysis, do me a favor, subscribe and comment Fin Talk OG so the algorithm knows you want more of this. Now here is the claim making the rounds. And Poland's gold buying is symbolic, political, or just some one-off reserve adjustment that does not really matter. And on the surface, that sounds sophisticated. But here's the contrarian insight. The more you study what central banks themselves are saying about reserves, crisis risk, and diversification, the less Poland looks unusual. And the more, it looks like a country taking the current reserve world seriously. So let us start with what we can verify. Recent central bank gold demand data shows Poland has been one of the biggest buyers and recently the largest. Its gold reserves have climbed sharply. Gold has become a much bigger share of total reserves, and the central bank has openly talked about security and higher allocation targets. That is not decorative buying, that is balance sheet behavior. And here is what nobody wants to say. Countries do not buy gold in that size because they want a nice headline. They do it because reserve assets are not all equal when the world gets messy. Now, here is the clean way to think about it. Gold in official reserves is a poker table signal. The speeches are one thing, the chips on the table are another. When a central bank raises gold meaningfully, it is showing you what kind of insurance it wants more of. And recent survey work on central banks makes the logic very clear. Crisis performance matters. Diversification matters. Store of value matters. And for many reserve managers, especially outside the old reserve core, geopolitical diversification matters too. Let me be blunt. When central banks themselves are telling you they care about crisis resilience and geopolitical risk, Poland does not look eccentric. It looks logical. Now, here is the skeptical alternative. Could Poland be a special case? Sure. Geography matters, history matters, domestic politics matter, and I'm going to say something that might annoy both sides. Not every country will copy Poland ounce for ounce or at the same speed, but the logic does not need to be identical to be contagious. This is where the mainstream story gets weak. Copy does not mean duplication. It means more countries deciding that part of their reserves should sit in an asset with no one else's promise attached. Same asset, different interpretation. For one country, gold is inflation ballast. For another, it is crisis insurance. For another, it is geopolitical diversification. For another, it is public confidence. That is why Poland matters. And it normalizes the idea that a central bank can meaningfully raise gold allocation and explain it in plain strategic language. Once that becomes normal, more countries can revisit their own targets without sounding fringe. Now let us talk about why this matters for the market. Official demand has stayed structurally strong even with gold already elevated. That tells you something. Central banks are not blind to price, but they are not trading gold the way a hedge fund does either. They are thinking in decades. This is the house foundation metaphor. If you are worried about the foundation, you do not stop reinforcing it just because materials got more expensive this quarter. You may slow the pace. You do not abandon the project. So, what does this actually mean for you? It means stop treating central bank buying as a side narrative. And it may be part of the floor under the market, not a floor that means gold never falls. Gold can absolutely correct. A correlation is not a contract. But if more countries quietly adopt the same logic as Poland, you get a different kind of buyer in the market. Slower money, stickier money, strategic money. Here's a question for you. Do you think Poland is early, or do you think it is overreacting? Drop that in the comments because I read them. Because your answer says a lot about how you think reserve managers should behave in a less stable world. Now, here is a simple action plan. No drama. Step 1. If you are a gold investor, write down whether you think central bank demand is cyclical noise or a structural shift. Step 2. If you want to track whether more countries might follow Poland, do not just watch the biggest usual suspects, watch the mid tier buyers and the long tail. That is where normalization happens. Step 3. If you are expressing this through gold equities, remember, strong gold demand helps the metal more directly than it helps every miner equally. Chase the mechanism instead. Costs, margins, jurisdiction, and management still matter. Step 4. Keep it sane. Gold does not need leverage to be exciting. If you want to understand whether this trend is still building, you do not just watch the gold price. You watch reserve additions, central bank survey language, and whether official buying stays resilient even when gold is expensive. If that keeps happening, that is a tell. Now let us map two plausible paths without pretending we can predict the exact candle. Path 1 is the normalization path. Poland stops looking remarkable because more countries gradually raise gold allocations in a measured way. Gold stays supported by a stronger official demand floor. Path 2 is the stress accelerator path. Another geopolitical or financial shock makes Poland's logic feel obvious to a lot more reserve managers all at once. Then what looked like a steady trend starts moving faster. I am not predicting it. I am saying it is within the set of things this market is capable of doing. Now, here is the uncomfortable truth. A lot of official commentary still talks about reserves like this is only a yield and liquidity exercise. That is the brochure version. The real world is more political, more fragmented, and more conditional than that. Access matters, trust matters, neutrality matters, and institutions protect themselves accordingly. Our regular investors are often told gold is just a fear trade, while official institutions are quietly treating it like strategic insurance. That is why a defensive strategy matters. 1. Decide your maximum allocation first. Write it down. If you are losing sleep, you are too big. 2. When something runs hard and you are up a lot, take some off. Not all some. If your position doubles, consider trimming half. Lock in the original bet. Let the rest run. 3. Do not use leverage or confuse narrative with mechanism or keep all of one thing in one place depending on the topic. 4. The best time to buy is not always when you are most excited. The best time to buy is when you can still breathe. So here is what we covered. Poland's gold buying matters because it may be a template, not a curiosity. The motivations behind it, crisis resilience, diversification, and strategic reserve autonomy are not unique to Poland. And if more countries follow even part of that logic, gold can keep building a stronger official sector floor than many investors still appreciate. That mechanism is doing something most people do not see or will not understand until it is too late. Stay alert, stay thoughtful, and do not let old reserve narratives talk you out of seeing what institutions are actually putting on the balance sheet. Now, here are my questions for you. Do you think more countries will quietly follow Poland into larger gold allocations? And do you see central bank buying as a temporary cycle or a long-term structural shift? Drop your answer below and remember to include what day and date you are watching from. If you got value out of this, subscribe and comment Fin Talk OG. So I know you want to follow up on central banks, reserve diversification, or the best ways to express a long-term gold thesis. All right, take care of yourself, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.